Good afternoon, ladies and gentlemen. Welcome to the DP Poland PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company will review all questions submitted today and publish responses where it is appropriate to do so, and these will be available via your Investor Meet company dashboard. Before we begin, if I may, I would like to submit the following poll, and I would now like to hand you over to the executive management team from DP Poland PLC. Niels, good afternoon, sir.
Good afternoon, thank you. Welcome everybody, and thanks for joining today's presentation. I thought I would just start today with a quick little summary of my thoughts on my first 12 months in the job. I've been in Warsaw for a year now, 13 months. We've made many changes to the business, and we've seen huge turnarounds in all aspects of the business, from our office all the way down to our stores. We've moved our average order count from 600 when I first got here, and now we're sitting in the low 700s. So we've really moved the bar in our order counts and sales. We've changed the company from a loss-making company to where it is today as a break-even. And this is despite the huge inflations that Poland and Europe received in the last six months of last year. So our marketing is working. Our operations in our stores get better and better, and it's certainly working. So what we're doing is working. We don't want to change anything. We're just on this journey, and things are going really well. Stage two. So that's stage one. That's done. Now we move into the second stage of what I'm trying to achieve here, and that is to get our order counts up. So the food costs last year was a headwind. Now it's a tailwind. Our labor costs continue to come down with our new scheduling system that we introduced last year, and sales and order counts continue to increase this year as well. So everything's working in the right direction. I feel we need another 10% order count in this second phase, and that'll really ensure that the company is a profitable company, and it release all of the profits out of the stores. Once we achieve that, once we head into that close to 800 orders per store per week, then we'll be into the exciting stage, and that's stage three of my adventure, and that's franchising. And so as soon as we can get to close to that 800 order mark, then we'll have confidence. The company will be nice and profitable. The stores will be nice and profitable, and then we'll be confident to start pushing the franchisees. We'll be able to open up more franchise stores and more corporate stores. So that's sort of where we are at the moment. Stage one is done. Now we're into stage two. And the exciting part will be moving into the last stage where we franchise and open lots of stores. So I'll start today's presentation. Okay, so some highlights from last year. So I started in June last year. First thing we did was bring the high volume mentality, and that is not only in the office but in the stores as well. So we've really changed the mindset in the whole company. This really just comes down to trying to serve as many customers as we can, and that mindset is now in, and it's the way we make our decisions. So last year we also expanded into Croatia, which is very exciting for the company. We ended the year with 116 stores in both countries. We did close 10 stores. That was part of our plan and my 100-day plan when I first got to the company. So we ended the year with 116 stores. Another big thing of mine was faster delivery times. So in the second half of the year, we actually decreased our delivery times by nearly 15%. Like-for-like orders, we're at 10% for the whole company. Like-for-like sales is 21%. So some big numbers there. EBITDA, we improved by 50%. And they're the big highlights for the year. So today we're going to talk about the company and who we are, the business environment in both Poland and Croatia, our group results, our market results in both countries, and then a quick 2023 update, and how we're going this year. So I'll start with myself. So I'm a real Dominoid. I've been with Domino's for 29 years. So my whole life I've been with Domino's. Most of my years were in Australia as a franchisee for the Australian business DPE. 3 years ago, I moved to the Croatian market and bought the master franchise agreement for Domino's Pizza in Croatia. And 12 months ago, I moved to Warsaw and I've been here ever since and joined DPP. Today, also, I'm presenting with Edward, our CFO. Edward, if you want to introduce yourself. Okay, obviously, Edward's finding it hard to dial in. Are you there, Edward?
Hi, Niels. Please do just bear with me while I reconnect Edward to the room.
No problems. I'll continue on with our
Thank
board.
you.
So, we do have a very strong board, brings a wealth of knowledge to Edward and I. I'll start with Shamek and Cuba. So they're both partners in the private equity fund ACP. They're our biggest shareholders. They're both Polish, live in Warsaw, know the market very well, and have vast experience in growing businesses. Then we have Jeremy Dibb. So he's our investor relations expert, and Jeremy personally has really helped myself and Edward get better at what we're doing today and improving our whole investor relations area. So he's a big part of our business. And then the last two gentlemen, look, they really strengthened the team. So, they've both been in my position. They've both been CEOs of a Domino's pizza brand. And the guidance they give to me is invaluable. So we have David Wild, the ex-CEO of the UK business, Domino's Pizza Group. And then we have Andrew Rennie, who's the ex-CEO of Domino's Pizza Enterprises, and Andrew headed up the European business. So between those two gentlemen and myself, we have lots of Domino's experience now sitting on the board. Edward, are you back with us as yet? No.
Hi, Niels. We're just going to connect him back through now.
No problems. Okay, so we'll continue on. So look, we're not reinventing the wheel here. We aim to emulate the success of Domino's Pizza franchises across the globe. So there's plenty of successful Domino's Pizza franchises. We're the number one franchise pizza business in the world. David Wild comes from the UK business. Andrew and I come from the Australian business, and that's what we're trying to emulate. So a quick rundown of our history. So 2010 is when DPP listed on the London Stock Exchange. By 2018, we grown to 60 stores. 2020 is when the excitement started. So that's when we merged with the Dominion brand. So that was a local Polish company, merged with Domino's, doubled the store count, and we got to 120 stores. 2022 saw the acquisition of the Croatian business and the master franchise of Domino's Pizza Croatia. And at the same time is when myself and Andrew Rennie joined the team here. 23 early this year is when David Wild joined our business as well as our new chairman. So it looks like we've got Edward back with us. Edward, if you just want to give us a quick rundown of your history as one of today's presenters.
Yes, I hope I have a chance now to say a couple of words. Apologies for being disconnected. I joined the Domino's world December 2022, and that was a real pleasure to join such a great team. My background is completely different to what Niels is representing. I have never been in restaurants business so far. However, my whole career I was connected with the retail. I hold a couple of different positions from financial roles via the strategy and development roles, implement.
Okay, looks like Edward's not having too much luck. Okay, so I'll continue through. Sorry about this, everybody. Okay, so 2022. So I started in June last year. And it's the first time the company's had a real Domino's guy actually running the business. So I've been with the company for 29 years. I've made pizzas, I've made dough, I've done deliveries, I've served behind the counter. So I know how the store operations work, and I know how the store economics work. I've been a franchisee, so I've been there and done that. I know what makes the dial tick, and I know how to improve things. So, with that, working with our marketing team, and we had Patricia join the same time as myself last year, and then not only do we have a new marketing team that's fantastic, but we've also got myself in the background with all that experience. I know what really works. So between myself, the marketing team, and operations, we've really had a big 6 months at the end of 2022, and we're really excited to share our results with you today. You're back, Edward.
Apologies, everyone. I don't know what's happening with the connection, but I hope this will not last forever. So 2 words about me. Very quick, joined the company in December 2022 with a complete different background that Niels has, because I have never worked in the restaurant business, although all my career is connected with the retail industry, either on the sales side, on the production side. I had the pleasure to run different financial and management roles in Kimberly-Clark, Smeg Levi's, and Mars, running the e-com launch in Romania or expanding the business to the Central Eastern European countries. I hope that my experience will be complementary to the Niels' experience in the restaurant Domino's world.
Cool, thanks, Edward. Okay, so back to 2022. So when I first started, like I mentioned before, we started the high volume mentality, and that's setting new goals like 20-minute deliveries, trying to break sales records. So we have changed the mindset of the company, and that is a big part of our success today. I came along. We changed our pricing strategy. We changed our discounting strategy. We looked at our menu, and we reduced our menu size to make it easy for our stores to make the pizzas faster. We went through our whole network portfolio of stores, worked out which were our stores that weren't working, why they weren't working, and then we decided to close those stores. We finished the full rebrand from Dominium to Domino's, so every single store in Poland is now a Domino's Pizza. We got our delivery areas, we reduced the sizes of our delivery areas, brought our labour down, made our deliveries faster. We massively brought our delivery times down. So we did a lot, and we made it all happen. And the sales really started to kick, and we started to get the rewards. So look, we are a customer-centric organisation, and we do listen to the customer. So we have a no compromise on pizza quality. We've got no problems with upgrading our toppings, putting more cheese in our toppings. We'll do whatever it takes. We listen to the customer, and we'll do whatever it takes to make sure that we have the #1 pizza in Poland and Croatia. Value for money, it's so important, especially now. With the economics the way they are today, people are really watching their pocket, and value for money is really, really important for us. Delivery times, that's a passion of mine. We've reduced the delivery times throughout the whole country, from where they were to where they are today. Delivery times is everything, and delivery times drive sales. Over to the top right, online development. Online is a massive part of the pizza business. Last year we were 62% online sales, and we want more. So we're investing a lot of money on our website, on our mobile app. Online is the future, and it's the future for the pizza business. So we're continuously investing and continuously improving in this aspect, and you'll see later on in the presentation we're getting some really good results as well. Simple as more. Look, we have lots of processes, and we're trying to make them more efficient, and we're trying to bring savings to the system. So we're continuously working on projects to try to bring the cost of our business down and bring more savings to the system. Development. We've designed our new look, our new image for our stores. I'll show you some photos later on the slide. We're really happy with them. We think our stores look great. And so we'll just continue to upgrade our older stores with the new image, with better equipment. We're doing that now, and we're getting really good returns on investment. Biggest thing for me, high volume mentality. So we came along, the first thing we started doing was reward the managers for hitting our KPIs, really simple: delivery times, sales, labor. And we put it out there, and we shared with them what we want to hit. Then we incentivize it, and we paid manager bonuses. We also created competition. We rank our KPIs. So, we all know what each other are doing. When our peers know what each other are doing, and we've made it a competition. We always want to be first. So that's been a big part of our progress. We listen to the customer. We give them more of what they want. We made sure that we make a great pizza. We've made sure that we sell it for the right price and offer value for money. And we've brought down our delivery times. Our goal is 20 minutes, and we're well on the way to hitting that. If we can make all that happen, volume goes up, customers go up, and so does the profit. Okay, so the business environment. Edward, if you want to give us a brief explanation of how Poland and Croatia are going in the business environment, and maybe touch on the inflation as well.
Yes, with pleasure. I hope I will not have a problem with connection, so I will manage that. Central Eastern Europe is nowadays treated as the area where the growth is much higher than in the Western countries. We can see it on two graphs right now. On the left-hand side, a point of start is the Q4 2019, which is before the COVID. Then all the European countries had a big downturn, and then there was a bounce moment around mid of 20, and we see easily that the Poland overbeaten the rest of the European countries with a pretty stable growth rate over the last 3 years. On the right-hand side, you have an extract with the annual dynamics, and this is just about the Central Eastern Europe major countries comparing to the European average. And again, here Poland and Croatia delivers more than European average and is beating the Czech and Slovakian market. That gives us the right to put a thesis that Central Eastern European countries will be eliminating the gap between this region and Eurozone. And in the coming years, we have a big chance for further development and expansion. This slide gives a bit different picture. On the left-hand side, we see a real GDP per capita in 2022. We can have the first feeling that there is a still big gap to the European average. However, on the right-hand side, when we translate these numbers with the purchasing power of the GDP, we can see that Poland is already close to Spain and is just 20% behind the UK GDP adjusted by purchasing power. Croatia is a bit lagging behind, but with the growth rates that we saw on the previous slide, as well as the gross disposable income per capita trends that you see on the bottom left graph, we can say that the potential for further growth and for the improvement in the wealth of the economies and the populations in those countries is big. And running the business on the growing markets is exactly the place where we want to be. One perspective is, of course, the macroeconomic dynamics, but on the other hand, we cannot forget about the pressures that we faced over the last year. 2022 was a very challenging year in the aspect of the inflation, which was driven by three major factors. That was the energy cost, food costs, and the labor market. The inflation almost doubled in some aspects, even tripled over the year. On the right-hand side, you can see that the energy cost in Poland over the year almost doubled, and that had an important impact on some of the economy sectors. So Having in mind this kind of an environment, I believe that on the next slides we will prove that we delivered pretty good results, and if the economy will stabilize, our positions to grow and develop is correct. Bit of the insight to the sector, because macroeconomy is one parameter, but the second parameter is definitely the environment we play in. As you can see, at the retail sales prices, the pizza sector in Poland is currently valued at 1.3 billion pounds, which is a pretty massive number. But what is even more important is the dynamics of this sector over the last 5 years. We see that it grew year on year almost 10%, and having in mind such conditions like COVID times and the turbulences from the last year, we see that this market is still not saturated and there is a big potential to grow. At the same time, we are aware that the market is massively defragmented. Only 1/4 of the market is driven by the chain restaurant, which means that 75% of the business is in the private hands, and this business is with a big pressure of the inflation. So we treat this moment as an opportunity for our business. We want to grow our market share in the sector and also on the market that is expanding. Our additional good position for the development is the fact that the quick service restaurant in the pizza sector is only at 24%, which means that most of the players are rather within the normal full service restaurant sector. And with the growth of the cost for the rent, with the growth of the labor cost, this is the positions that give us the competitive advantage and the first positions in the development of delivery and carry-out business. Niels, in your hand.
Thanks, Edward. So currently, we are the third largest pizza brand in Poland. So number one is a local pizzeria called De Grasso, and number two is Pizza Hut, and we come number three. So look, we have lots of room to grow lots of stores. There's 380 counties in Poland, plenty of room to build pizza stores. There's 40 million people here. We simply don't have enough stores. Where we are dominant is in Warsaw. And what we're seeing, especially this year here in the first quarter, we're seeing big growth out of our Warsaw stores. They are our smallest delivery areas. They have our fastest delivery times, and consequently, they have our lowest driver labor costs as well. So, when we have lots of stores in close proximity, that's when the store economics really start to explode. You can imagine a Pizza Hut having 2 or 3 Domino's stores around them, how hard that must be for business, and customers aren't going to walk past a Domino's to go to a Pizza Hut. So we simply need more stores and the opportunities here, because there is a lot of people in Poland that we aren't serving currently. Okay, so group results. Edward, if you want to talk about the group results and EBITDA.
Yes, with pleasure. So looking at the numbers, it's fair to say that we are really proud from the top line growth, which is double digit and close to 20%. And that wouldn't be possible if the top line growth was not driven by the order count and also by the proper communication with the consumers, because in the era of the inflations, generating the nominal increase is easier than generating the real turnover growth. From that perspective, we are happy with the split between the average ticket value increase and the order count. You will see it on the next slides. Average ticket value was also increased not only by the nominal price increases, but the proper insight to the product improvements and new product developments, and also the pricing strategy revision and promotional revision. At the same time, we looked closely into the specific needs of every channel that we have. That had good results in the development of dine-in, carry-out, and delivery. and we hope to stay within this corridor for the future. Concerning the consumers, this is the high volume mentality that was implemented as a mindset to the organizations. And following this mindset, we also changed the communication pattern to the consumers, running more directed and targeted communications to our target group, which is between 15 to 40 years. That had impact also on our direct costs. It is visible in the SG&A. This change communication was the consequence of the change communication was a bit higher cost for this communication, but we see a good return on these investments in the top line. Generally speaking, the direct costs and SG&As were driven by the factors that also driven the inflation in Poland, which is and in Croatia as well, which is again labor costs, food costs, and energy. And this cost the 15 to 30% increase year on year. Looking at the direct costs, the dynamics are lower than the system sales, and this is something that gives us a good forecast for the future. Summing it up, the end results for the EBITDA is very promising. With this difficult market situations, we managed to deliver 50% of EBITDA growth over the last year. And if we had the possibility to have those market conditions improved in the next couple of months, we are pretty sure that our P&L will start be constantly positive. Below the EBITDA, there are a couple of factors that are important to mention that impacted the loss for the period. The first one is the IFRS adjustment, the right of the assets right for use for some rental contracts. This is connected with our store optimization plan. Simply, we are looking closely to the performance of some of the stores and taking into considerations the changing habits of the consumers. So therefore, the stores, especially in malls, which have, let's say, not a bright future, and it seems that they might be loss-making in the long term, we are simply reconsidering whether or not to relocate them outside the malls. From the financial operations point of view, there is a financial income that was presented in 21, and it concerned the reverse takeover. It was not repeated in 22, therefore this impact. In total, loss for the period is equal to the last year.
Well, thanks, Edward. Okay, so as I mentioned before, what we're doing is definitely working. So this is our group system sales. Top left, we grew quarter by quarter. And this is with closing the 10 stores, reopening 2, so net effective negative 8 stores. So with 8 less stores, we're still growing our system sales at this type of rate. Bottom left is the like for like. As you can see, that grew quarter by quarter. System sales in Great British pounds was 18.2% year on year, and like for like was 16.4%. So we're really proud of what we're doing. We're growing at a good pace, and there's not many other markets around the world that's seeing these type of numbers. Edward, if you can go through the group balance sheet for last year.
Yeah, sure. Short comment about the slide. Non-current assets stay stable over the year. However, there is a swap between the lines. Goodwill is growing in connections with the takeover of the Croatian business. At the same time, non-current assets are reducing in consequence of the depreciation expenses for 2022. Current assets, we see visible growth, almost 50% over the last year, for 3 major factors. The first one concerns the inventories. The inventory growth is a prevention plan for the inflation. We bought simply more cheese on stock for the purpose of mitigating the inflationary pressures on the prices. And thanks to that, we were able to incorporate positive effect on the P&L. Trade and other receivables are affected by the prepayments for the TV marketing campaign that was held in Q1 2023, and cash equivalents are improved by 50% in result of the fundraising that was held August 2022. On the passive side, in non-current liabilities, we have a major changes. The lease liabilities dropped by 20%, and this is connected with the store network optimizations. We entered the year with 121 stores and end up with 116. And the borrowings, this is connected with the loans provided by Malacan Holding, one of our major shareholders, and the increase is connected with additional loan closing the reverse takeover of the Dominion business and accrued interest in 2022. Thank you.
Awesome, thank you. Okay, so now we'll go into the market update. So this is Poland, and look, I keep on saying it, but we're really happy with the progress in Poland. 20% up in sales, and 43% of that, or close to 50%, is being driven by customer count. So it's not that we're just putting up our prices because of inflation. We're getting that double-digit customer count growth as well, and combined with our pricing and discounting strategy, that's how we're seeing our 20% growth. How are we doing this? It's all of those things I mentioned before. It's our high volume mentality, it's our competitive pricing, reducing our delivery times, doing our stores upgrades and making them look more appealing and sexy. So everything that we're doing is not one thing that's just driving the sales. It's a bit of everything and all coming together nicely. Okay, like-for-like sales is even stronger. So the like-for-like orders, we're at 10% for 2022, and for sales we're at 21%. So some really solid numbers. You can see the big growth was in carryout, so we were over 90% up on the year before in our carryout. So that was one of the things we identified when we first came to the market. There wasn't enough carryouts here, and especially with the way the world was going and inflation increasing, it was really good timing to be able to come to the market and offer some good deals and value for money for the customer. People are shopping less at restaurants, but they still like to treat their family. So, we can come along, we can offer a good price and good value for money. They can grab their pizzas, take it at home and enjoy it with their family at home. One disappointing aspect was the delivery side. We were 15% like-for-like down in our delivery sector of our business. We identified that pretty early on, and by the end of the year, we were already overtaking the zero. And what we're seeing this year in the first quarter is that we are now double-digit on our delivery as well, on our carry-out and our dine-in. So we're happy with all three sections now. We've got a good mix, and we're really happy with the growth. Okay, so this is one slide that we're really quite proud of. So like I said at the start of the year, DPP's been hovering around that 600 order mark for quite some time now. We've brought in all of those changes, and we've pushed it up to 700. And at 700, we are seeing the stores break even. And that's when we need to enter into stage 2. We need to push the order count another 10%, so that we're hitting that 780, 800. And then that's when you'll really see some healthy store profits. We'll be able to start seeing good profits in all of our stores. And then we'll be able to move into our third stage, and that's when we'll start seeing franchisee growth, franchisee stores starting to open, and then we'll be able to unleash capital by selling down our stores and also open more corporate stores. So that's where the growth and the fun starts. At the moment, we're in consolidation mode, and we're trying to make the the company as profitable as it can. So they were a very solid business. On the right-hand side, delivery times. I said it was important, and it really is. When I first got here, we were above 30 minutes for deliveries. We have got that down. So we've got it down. We're halfway to my target. We're sitting at 25 minutes. Are we happy with that? No, we're not. I've publicly said that our goal is 20 minutes, and that's what we're going for. The guys over in Croatia seem to run about 22 minutes. So we've got that first goal to try and hit, and we've got a few things up our sleeves to help the teams get that along and try and save a few more minutes off our delivery times. You can see here in December, delivery times blew out. That was the World Cup. So, our mix of sales, got to 90% delivery mix, and our delivery drivers are also Polish, and they also like watching the football. So it was a hard time for us. Delivery times did blow out, but it wasn't just us. It was our competition. It was the aggregators. It was a tough month for everybody, but we enjoyed the sales. And then after that, we got our delivery time straight back down, and it's been sitting there ever since. Okay, so here's some photos on the left-hand side. This is what our new store image looks like. This is a new store in Rumio in the north of Poland. Like I said, we're really happy with the new image. And this store here opened 3 months ago, and it's already doing above the national average order count. So we're really happy with the success of the new store. On the right, you'll see this is an old store that we've gone in and upgraded to our new look. We've also rearranged the kitchen, and every store that we've done since I arrived that we've actually upgraded. We're getting massive sales growth. Much higher than the average nationals. Our service times are coming down, and our labour times are coming down as well, just because we've got more efficiencies in the kitchen. So what we're doing with the store image and the upgrades is really working. We're getting good return on investment, and we'll continue to do that.
Yeah.
Edward, if you can take over this slide, that would be great.
Yes, with pleasure. This is my last 3 years history in the e-com, so definitely I will be happy to comment that. So top line is of course a matter of couple of factors. The first one is definitely delivery times. This is the product quality and the way how it is provided to the consumers, value for money. But another parameter that is extremely crucial is the way of communicating. We know that our target group sits between 15 to 40 years old, and this is that means that to get to them, it's good to be in the communication source that they consume most, and this is the internet. For that reason, and also for the reason of boosting the frequency of our sales, we developed the mobile app. It's already older than 1 year, so we have some history over the mobile app. And together with the mobile app, we are looking closely how we develop our communication pattern. So we try to increase our consumer base. We increase the text message contents, email contents. We push also on the installations of our mobile apps on the Androids and iOSs. And we see already that we have a good effect out of this, because the net sales from the apps are growing almost 4 times over the last year. This is not for the purpose of having a good communication pattern with the consumers and sending them directed and targeted promotional actions. But at the same time, this is also a source of reducing the consumer activation costs, because communicating via own platform and eliminating the paid search on the Google is a direct impact for our P&L performance. This is one of the parameters and one of the communication platforms we are looking very closely to, and we plan to develop it for the next months and years.
Awesome, thank you very much. Yeah, we're really getting some good momentum there. Okay, so this slide here, this really shows the journey that we're on. So I arrived halfway through the year, and you can see the store EBITDA turnarounds and what we've been able to achieve. So it's certainly come with its challenges. Yes, we were having good sales growth in the second half of last year, but we're also having food costs growth as well. I've never seen food costs so high in a store. You can imagine how it would have affected our EBITDA. I mean, we were experiencing food increases of up to 20%. So, do the maths. You can imagine how much that would have affected our EBITDA, but it didn't. We went the other way. So, that was my goal, is to try and get this company to cash flow positive. And it was really tough with all of these food prices against us. But we found the efficiencies in other ways, especially in our labour. So as our food costs were rocketing high, we're bringing our labour costs down the other way. And it wasn't because we were giving worse service. We were delivering to the customer, 5 minutes quicker. So we're delivering faster and bringing down the labour costs in our stores. And with that and the extra sales, that really offset the food price increases. And now we can really see. So our last year the food prices was definitely a headwind, and now it's a tailwind. So we're really happy with the way things are heading at the moment. We've got our food prices coming down. We're continually pushing our labour costs down as well. And as you'll see in the next few slides, sales are still continuing as well. So we're feeling good, and everything's going in the right direction. Okay, so this is Croatia for last year. Okay, so we're seeing 92% year-on-year growth, and that's simply because we opened up a third store. We're still a small market. They opened up a third store, and it's increased our sales massively. As far as like for like, we're at 8.7% for the year. A lot of people would say that's a good result, but for us, that's not strong enough. We like double digit. And the good news is in 2023, Croatia is seeing those type of numbers. Okay, so now we'll go into this year. So the first 4 months of this year, we're seeing very similar results. This is in Poland. We're 14.9% growth. Again, that's with those stores that we closed, and then like for like is sitting at 18.4%. So we're seeing good growth by month, and so far we're really happy. So strong sales continue to move, and for the Q2 we've already announced that we're tracking the same as the numbers that we're seeing in the first 4 months. Okay, Croatia. We had a big hiccup there at the start of the year. In Croatia, they moved into the Schengen, out of the kuna into the euro, and that was on the back of the high inflation that Croatia received as well. So, the economy froze there for the first month of this year. People definitely stopped spending money, and it was the first time in a long time that we're seeing negative growth. But the good news is it came kicking back in February and March. February were 29% like for like sales, March were 27% like for like sales, and it settled down in April. So we're really happy with the growth in Croatia. 18.4% like for like, I think, is a good result. We just opened our 4th store there just under 2 weeks ago. It's been a really good start. It's really good to see that we opened up a store and the customers have come flying through the door. So what we're doing there is working. It's a really good market, and we just need to open up more stores. It's as simple as that. So here's some photos of our image and our team in Croatia. One thing I just wanted to mention here was, we're 100% e-bike. So we've just done our 4th store now. We do a lot of deliveries out of this market, and every single one has been on the e-bike. So you can imagine how much we stand out in the street and the road. We make sure our e-bikes look pretty amazing, and we're getting a lot of marketing and from that. So. Okay, so the next 6 months and our goals, what we're trying to achieve here. So, today we keep on talking about order counts. That is the most important part of our business. We're here to grow market share and to grow stores, but to get that, we need to get our stores to 800 plus. So that's our goal. That's what we're trying to do. We'll continue focusing on our brand positioning. We are number 3, so we can't forget that. So we still need to do a lot of work to make sure that we're number 1. we want lower times. We need to reduce our delivery times even more. We need to shave off a few minutes for our carry-out customers, and we feel we can shave off a few minutes off our delivery times as well. Product quality, like I said before, we're a pizza business and we need to make sure we're selling the best pizzas in Poland. So, we continuously listen to the customer, doing taste testing against our competitors, and we'll ensure that we stay ahead. Online sales, it is a big part of our future, and we're continuously working. And we want to get up into the 80%. We need to move the dial a little bit more on that, but everything's heading in the right direction. Franchisees, we may not be ready yet now, but we are providing incentives and support programs to try and motivate internal candidates into the system. We'll start looking at option deeds on our stores, and when we feel we're in a good position, then we will be pushing out the franchise stores, and we'll start growing our store count with franchisees as well as corporate stores. Our commissary, we've got a few projects there we're working on. We still feel that we can bring some savings. We have brought some savings to the system already by cutting out the number of deliveries that we do from the commissary. But we've got some more savings that we feel that we can get as well. As for store openings, that's not our huge priority at the moment. Our priority is to make sure that this company is cash flow positive. That's what we've been working on. So our store opening is slow, but that is our goal. And when we enter into the stage 3 of this journey, that's when we're really opening up a large number of stores. So we've got 2 stores we're working on in Poland at the moment. They'll be open in autumn, and same as in Croatia. We've got a 5th store we're working on at the moment, and that'll be open in September. And that is my presentation for today. So we'll open up for any questions. I see there is a whole lot on the right-hand side.
Niels, Edward, absolutely, and thank you very much indeed for your presentation this afternoon. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the team take a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Edward, Niels, as you can see, as you did kindly mention, we have received a number of questions from investors, and if I may just now hand back to you to respond to those where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Okay, good afternoon. I was nominated a question coordinator, so I will allow myself to address these questions. There were some questions that have been pre-submitted, so maybe I'll start with those. One of the questions is, I will read them loud. I believe it was early in 2018 when DP Poland first did a substantial national advertising campaign and sales rose very substantially. However, at that point, the store estate was not really big enough. How do you see maximization of the potential of the current estate in the context of the board's strategy of growing market share? I guess, Niels.
Okay. So we went on TV. We did just a short test, so we're on TV for 6 weeks earlier this year. Look, we're really happy with the success. We would like to go on TV more. It is expensive, and the issue that I see is that we don't have stores all over Poland. So the problem is that we're advertising in areas where we're not selling pizza. So it definitely works. It really helped our brand and our awareness, and we will definitely be going on TV in the future. But we feel now that we can direct our costs more efficiently and get more bang for the buck by using digital and really targeting our customers and where our stores are. So to answer that, very successful. Really happy with it. Can't wait to go back on TV again. But our priority is to get the company into cash flow positive, build the stores, and then we'll be able to go back on TV and really push the dial there.
Yeah, thank you, Niels. There's an additional question that I think is connected. It comes from Tom. Maybe this one to be addressed by either Edward or Niels, because it deals with the e-commerce. Any plans to expand and invest in the digital experience for customers, given the significant proportion of sales that they represent?
Look, we're always working on that. So we're always upgrading our digital platforms, try and make it less clicks for the customer. We're bringing in, we've brought in a lot of ways to upsell to the customer as well. We've got our mobile app. I suppose the big thing we're looking at is our aggregators. They're all on their apps as well. We're definitely seeing the aggregators in Poland trying to increase their fees they're charging. So prices are getting higher on the aggregators. So I feel that's a good opportunity for us to try and steal a little bit of market share from these guys. We know that restaurants, when they go on an aggregator, are simply increasing their prices compared to when you walk into the restaurant. So we definitely see an advantage there, and we can offer value for money to our customer by using the avenue.
Okay, thank you. There are a couple of questions targeting, I think, similar topic. It came from Mark, from Stephen, and some others. It's basically, I will just read one of those, but it reflects the other ones as well. Will you need more funds to achieve your ambitions? Edward.
I would say the following. Currently, we are in the mode of growing organically. We are looking at our business in a careful way. Simply, we do not want to repeat the historical situations. We are investing carefully into the new openings and into the further development of the organizations, looking for the best payback periods. So and we are getting to the cash neutral positions. This is one of our major goals, so that we are not cash eaters. We rather start generating the cash. So when we land in the area of continuous EBITDA growth or continuous EBITDA positive numbers, that will be the moment of moving easily to the stage 3, which is transforming of the company to the franchise model. And with the transforming of the company to the franchise model, there is one very important factor that has an implications of the whole company. We start selling the stores to the franchisees, which is a cash generator, and we are getting rid of the processes and management of the stores in day-to-day operations. So we will be moving towards a capital light industry or capital light company, which will definitely improve the free cash flow in the long term. So having said that, I would say that definitely the 12 to 18 months will be the moment of these transformations and will be crucial for this. For now, we do not see any need for fund. We feel ourselves stable and secure on the cash position. We did the going concern calculations, and we see that we are safe in that matter. Of course, depending on the development of the organizations, whether this will be organic or whether this will be via the M&A, that we also look into this. We are not desperate, but of course, this is one of the areas, especially on looking at the fragmentation of the market, one of the areas that we look for our success. Then this is a completely different project that requires much more capital funding than the organic growth. And in that aspect, then potentially we can look for some funding.
I think you touched upon the next question that popped up, I think, 3 times. Stephen put it very bluntly, acquisitions ? Maybe.
As I said, maybe Niels, if you don't mind, I will just step in and will transfer it to you. We are not desperate. We simply see that the market is defragmented, and looking into the Western countries where this market is dominated by a couple of key players and followed by lots of challengers with smaller businesses. Poland is completely different place, and Croatia is even more defragmented than Poland. So from that perspective, this is a very natural perspective for the further step growth for the organization. And this is what we'll be looking at, but we are not desperate. We just be looking for the good opportunities. Niels?
Yeah, exactly right, exactly right. That's certainly one way to increase our growth plans. So yeah, we're looking into it. That's all we can say.
Okay, thank you. There are two other questions about the sub-franchising. It has been covered, but it's clearly there's some additional clarification needed. So I will read the one that was pre-submitted. Now that DP Poland's store estate is at a critical mass and being optimized, are you able to comment, please, on future expansion sub-franchising? Sub-franchising can produce very attractive returns on capital. What proportion, if any, do you have in mind for sub-franchise stores out of the total potential store estate? And then there was additional question from Mark about the time scale for that. Niels, can you comment?
Okay. Yep, of course. So, like we mentioned before, we are trying to emulate the successful Domino's brands around the world. So, what they have is a more franchise model, small corporate store model. What we have in Poland is completely opposite. So, yes, it is part of our growth plan and stage 3 of what I'm trying to achieve here. It's exactly what we're trying to do. So, we want a complete flip. I mean, we would like to have a small amount of corporate stores and a large amount of franchisees. When you have a large amount of franchisees and the business is strong, then you have 40 or 50 guys along with us growing the business. And if you can have 40 or 50 entrepreneurs all growing 1 or 2 stores a year, that's when you can really start to get some serious growth. So, we understand that is the future. Yes, it will make less from a franchise store than a corporate store. But what we're seeing is that franchisee then goes into the second and third and fourth store, and so ultimately we get more money from that franchisee everywhere anyway. So we've got no problems with selling down our stores. We want to do that. It'll release capital so that we can then go and open up more stores. I mean, we should have 400, 500, 600 stores here in Poland, and we don't. So just because we start franchising doesn't mean that we'll stop the corporate store growth, but we want franchisees in the system. As far as timing, we've got 4 franchisees at the moment. They're great franchisees. Their business is growing. Their profits are healthy, and 2 of them want to expand. So we do have franchisees, but before we start selling down the rest of the stores, we want to make sure that we're confident that the new franchisees that come into the system are successful. If we're to bring in external franchisees, we need to make sure that the P&Ls are great and that the stores make money. For the internal guys that we option deed some of the stores to, we need to make sure that they're going to be successful, because success breeds success. So to get to that, like I said before, we need to get to that 800 order count. How long is that going to take? It took us a year to get the 100 orders. It might take longer. So 12 months to 18 months. And I really feel that we're going to be able to be confident, get some good franchisees into the system. We'll start to see them growing, and then the snowball effect will come. There's a lot of markets around the world where Domino's franchisees are lining up to buy a store. So, that's our goal, and that's where we need to get to.
Thank you, Niels. Another question addressed to you coming from Tom. Niels, as a veteran in the industry, what do you see key to the success of the business moving forward, and how optimistic do you feel about the prospects for the company moving forward?
Okay. Yeah. I mean, I've said it before. I don't think we need to change anything. I think we've made the changes, and they're working. So, all we're going to be doing is doing the basics better, trying to do better in what we're doing at the moment, and that's all we need to do. The formula's working. So we just keep on going, and customer counts are continuously growing, and we will get there. So how confident am I? Absolutely. I mean, we're seeing, I'm sitting here on the ground, and we can see the excitement in the staff. We can see the excitement in the head office staff. We can see the customers coming through the door. So it's working. We're just going to keep on doing the same.
Thank you. There is a question from David. Could you please discuss the nature of your interactions with Domino's Corporate and highlight things you are doing which perhaps differ from the broad system-wide initiatives?
Yeah, look, we have a pretty good relationship with the US, and they have definitely been helping us in any way we can. So they've identified this market as opportunity to have a lot more stores than it does. So we have been targeted by them, and then when I came along, it was a good opportunity to really come and help us because we've got new management here. We're trying to make all the right changes. We're trying to do the right thing and embrace the Domino's model. So in doing that, we've had massive support. I mean, the team here in Poland have never seen so many American representatives in Poland are coming to the market, seeing what we're doing, offering advice. I mean, we've had the guys that run the commissaries in the US come over. We've had the guys that run the franchising system come over. We've had the marketing guy come over. We've had the big bosses from the US come over. So, they're always in our market and they're always at the other end of the phone with anything we need. So the support is great. We are open and we're hiding nothing, and we embrace all their help. We welcome them to the market and we enjoy working with them.
Thank you. Now, totally changing the topic, or maybe not totally, but materially, coming from SM. Is 8p share option exercise price sufficient to provide stretch and deliver share price growth for shareholders?
Okay.
So basically, do you feel that 8p per share is a good incentive, is a proper price in the stock option?
In the stock option plans. Okay. Look for me personally, it is a very good incentive. I can see the potential. I can see not only the growth in the store revenue and the store profits, but how many stores we can have, especially in Poland. We're in the right part of Europe, so the upside is unlimited. So for me, it's a massive incentive. I look at those numbers and. If I can get this right, it's a big incentive for me. So for me, absolutely it is, yes. Am I happy with the share price? Absolutely no. No, I'm not.
Thank you. Edward, do you feel incentivized?
Definitely yes, because look, this is not the exercise or the project short term that expects some return in 2 or 3 months for us. We look at that from a wider perspective. We were invited to the organizations for the purpose of delivering the transformation. So from that perspective, we look into this project in the perspective of 2-3 years to make a real step change for the organizations and to be in the different position. And when we look also at the prices of the shares on the stock exchange, we approach it in calmly and in a pragmatic way. Our main focus for now is to concentrate on the top line and on the order count and on the proper communications of the brand so that we can increase the brand awareness, increase the frequency of the purchases and bring the new consumers to us. This is the goal because today growth of the top line will bring us tomorrow profits. We will build a good base for convincing our future franchisees to take over the stores from us, and we will be in the position to transform the organization. And when we are there, I believe that 8% will be kind of a historical memory about the price of shares for us, and that the company will be in the different position. I think that the last 6 to 9 months prove that the chosen road is the positive, and we simply want to stay on the boat and go towards the future.
Thank you. Question from Mark. What level of monthly EBITDA would translate into positive free cash flow?
I'm not too sure what we can say on that, but maybe Edward, if you want to take that diplomatically.
Monthly EBITDA, I would say the other way around. If we were around 750 orders constantly a week a store, then we will be on positive EBITDA and we will start generating free cash flows. Free cash flow are also the equations with the capital investments. So depending on how we want to develop, then we might require more or less cash for the investments, but to be the operationally positive on the cash, I believe that 720 to 750 orders on average per store. This is the place where we want to be, and we will be pretty safe on the bottom line.
Thank you. And the last but long question coming from Peter. Has the largest shareholders' debt been extended? And if so, what are the terms, please? Don't you see a positive EBITDA trend this year and expect this to strengthen into year end? Any updates on M&A opportunities? That was, I think, already covered. Can you comment on the labor scheduling system implemented, expected results from this initiative? So many questions.
Okay. Yep, no problems. So yeah, I'll take over the tender labelling scheduling. So that is rolled out throughout Poland, and we're really seeing some good effects. So we started that project late last year, rolling it out into the stores, and we're getting labour savings every single month as more and more stores get used to the system and start using it. So one of the important things when you introduce something completely different is you need to have buy-in from the managers, and they need to actually want to use it. And the good news is that the staff and managers love it. So not only is it good for head office because we're controlling our labour, but it's much easier for the staff and managers to do their scheduling, communicate with their staff. So look, it's been a big win-win. We are seeing massive benefits, and what's really encouraging, we're seeing some really good savings in our stores, in our mature stores. So our stores that already run tight labour. One of our best managers, we're talking in a store that he's been running for over 3 years now, and even he found a 10% saving in labour costs just in his store, and we thought that was running pretty efficient. So really happy with it, and I think we'll just be seeing more and more savings as the stores get better and better at using it. As far as what was the question? Positive EBITDA trend this year. Absolutely, you can see from the graph what was happening last year. You can imagine now that the cost of food costs have gone the other way. So this year, yes, that trend, you'll be seeing a lot more bars on the right side of that line. So that's what we're trying to do, and we're on that journey to 780 to be profitable in all of our stores. And the further we get to that, the more of our individual stores are cash flow positive.
Definitely, we are on the growing trend. We need to be pragmatic with the expectations. We just approaching the green zone, so there are months that we are much better. There are months that we are less better, but generally speaking, we follow the trend that was planned, and we believe that we are entering to the green zone for the further continuously and sustainably presence there. Concerning the largest shareholders' debt, I would say it in the following: the shareholder is engaged in two ways. He's engaged via the ownership of the shares as well as the loan. He is very supportive in all aspects of our business, operationally and strategically as well, supporting us with some information and building the network and relationships with external partners as well. For every private equity, the horizon of the investments is between 3 to 5 years. The takeover of Dominion took place in 2021, so we are 2 years from that moment, and definitely they are playing for the proper return from this investment. So I do not, we as an executive team do not expect any surprises from them. The loan was extended by an additional year, and we have a commitment that we simply want to go through this transformation moment and bring the company to the green zone. So we feel confident that our loan and shareholder will be supportive in the mid to long term for us. Concerning the M&As, because that was another question, I think we already said about it. As I said, we look into the opportunities. We do it in a clever way. Simply, we are not chasing every single potential company to be taken over, because not all of them feed our strategy and have the assets or the organization structure built in a way that is easily to be merged. So for that reason, we are looking carefully to the market and trying to choose those that might be of some good potential for the expansion.
Okay, thank you. I
Thanks,
think we
Edward.
exhausted the list of questions.
Guys, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in from investors. Niels, perhaps before redirecting those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, of course. Yep. Thank you very much for everyone for attending today. I really appreciate it. I hope you enjoy listening to the journey that we're on, and I really can't wait to present next time and show you the next results and what we're trying to achieve. So phase 1 done. We're in phase 2, and let's bring on the last stage of our business. Thank you, everybody. Bye.
Niels, that's great. And Edward as well. Thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can better understand your views and expectations. This won't take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of DP Poland PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.